Appreciate the intro there. And I appreciate everybody joining this morning for legal terms. So a little bit about my background. I started my career as an attorney. I worked with several law firms, particularly out here in Silicon Valley. I worked with a lot of early stage companies all the way up to companies preparing for IPO, and got a chance to work with, see a wide range of things from the company side and representing different venture investors. After that, I spent a couple of years in the legal department here at 500, where, as many of you probably know, we're very active in investing both in the US and around the world. So got a chance to work on deals across North America, South America, Europe, Middle East, and a little bit of Asia. And now my role is more focused on working with our companies here in the San Francisco Accelerator, and new investments for the fund. But basically, I'm here to give you a brief intro into some of the legal terms that you should know as an early stage venture investor, and especially on the convertible side of things. So I'll jump right into the content now. As Patrick mentioned, we'll definitely leave time for questions at the end, because legal sessions are always more interesting when people are getting the information that they are actually curious about. So looking forward to those questions at the end. So with that, we'll jump into the framework that we're going to use for this morning session. So I like to break venture financings into a couple different buckets. So as you can see on the screen, the first bucket would be convertible securities. So this includes things like convertible debt or convertible notes, things like a SAFE or a KISS, which are different forms for a convertible security. The other bucket, the main financing bucket that people might have heard of, is equity financing. So a sale of stock directly to investors. So this would be your Series A, your Series B. I put Series Z at the end because there's really no difference or reasoning to the names. You can name it whatever you want. People have just chosen to go with seed A, B, C. The wild card here is there are things that don't fit into either bucket very nicely. So things like a ICO or crowdfunding, they're slightly different. So we're not going to cover that so much today, but particularly at Deal Camp, we get really deep into the equity financing side of things and touch on some of these other topics. But today we're going to talk mostly about convertible securities. So what and why would you use convertible securities? So these are primarily used by early stage companies, or a bridge round between, say, a Series A and B. And there's a couple of reasons for this. So the main one is that there's fewer terms here and there's less negotiation involved, so things can move pretty quickly. A lot of these forms, like the SAFE, which people are most familiar with, are easy to download from the internet. They're usually don't require a lot of customization. So both companies and investors that don't have a lot of experience or legal budget are able to use them to get the deal done quickly. The other big factor is that there's no fixed valuation. And this is important particularly for early stage companies, because it's very, very hard to try to value an early stage company. When a company has just 2 or 3 employees, maybe 2 or 3 customers, some monthly recurring revenue, but not a long history, it's hard to apply traditional finance models to try to come up with a solid valuation for the company. So convertible securities make it easy for an early company to get a deal done quick and without having to figure out something as tricky as valuation. Now, some people would feel differently about what this means, but we'll get into valuation questions in a few minutes. So the first type of convertible security that people are probably familiar with is convertible debt. Now, this is exactly what it sounds like. It's very similar to a loan from a bank where there's a note to be repaid. But the particular factor here that makes it important for financings is that it can also be converted into equity. And that's really what most investors, and I would say all investors, should want their note to convert into equity in this case. And it always has an interest rate and a maturity date in the US. These are often extended because most investors that are using these types of notes are really only intending to receive equity in the future. They're not particularly concerned with the small interest rate or having the note paid back at maturity within a year or two. If you ask any startup that I've ever worked with, or maybe any startup that most of you have worked with, when they receive money on a convertible note, they're going to immediately start spending it for marketing and hiring and all of the things that a startup might need. They're not holding on to this cash and preparing for a repayment in 2 to 3 years. And this is really, really important to note, both for investors and for companies, because if anybody, whether it's the company or the investor, doesn't realize that this is what's happening, it can be a big problem for everybody involved. So say 2 or 3 convertible notes are written, say for 100K each for a company, and 2 or 3 years go by and just one of those investors says in 2 years, I want to be paid back, and the company has no money, the company would be technically insolvent if that investor wants to pursue their claim to be repaid. And that would affect every other investor, that would affect the company. So it's really important, if you're using a form of a convertible note, to be aware of these risks and only take money from investors that are also aware of how this would work. And in response to this exact type of problem, the startup community has really switched more to forms that I'd like to call convertible equity. The SAFE being the most popular version of this. The KISS is the 500 startups version that we use for our accelerator programs around the world. And we've translated it for a number of different markets. So particularly in some places where SAFEs have not been adapted for use, we do have the KISS forms. But the main change for convertible equity is to get rid of these concepts that make convertible financings a problem. So for example, the interest rate and the maturity date are not required in either of these forms. So that gets rid of the issue of insolvency if there's no mechanism by which the investor can force a payout at a certain date. No interest rate reduces one tiny negotiation point as well. And for the company and the investors, interest is not typically a big focus. So this simplifies the form somewhat. So the only other thing to note on this slide is that not all forms are made the same. So there are additional rights that can be granted and put into any of these types of forms. So for example, most favored nation is one common variety of these notes that exist. And what most favored nation means is that if you're the investor and you are granted a most favored nation clause, if the company then sells a SAFE or a KISS with a different valuation cap and a different discount that might be better, if you have a most favored nation clause, you're able to match those exact terms. Some other common rights that can be granted are things like pro rata rights and information rights. So that would be rights to invest in future rounds of the company, or information rights to get quarterly financials and updates for the company. But it's really important to pay attention to what form you're using or what form the company is providing when you're investing, because not all SAFEs are made the same, not all KISSes are made the same, and you want to make sure you understand that what's different in this version than maybe the last deal that you did. This is particularly important these days because there have actually been some recent changes to both forms, where things have shifted from this idea of a pre-money SAFE to a post-money SAFE, which we'll discuss in a couple minutes, but it does make a pretty big difference on the outcome to both investors and to the companies. So how do these notes, SAFEs or KISSes, convert to shares? The main way that all these notes would convert is through either a discount or a valuation cap. So we'll go through the math on each of these quickly this morning, and this is where we're going to spend the bulk of our time. So the discount is pretty straightforward. It's a percentage discount on that future share price. So if the Series A price is $1 and your SAFE guarantees you a 20% discount, then you would just pay 20% less per share when converting your notes. The valuation cap is where things get a little trickier. I know earlier I mentioned there's no valuation when you're using a convertible security, but it's a little bit, depending on who you ask, they might have different opinions there, where the valuation cap is sometimes used as a proxy for what people think the valuation should be. But what it really is the maximum pre-money valuation that your safe investment will convert into equity. So the part I have highlighted here on the slide is it's actually the outer limit of the valuation that you're willing to invest that amount of money. So if I'm investing 100K into this company, would I do it if it was a 10 million valuation? Would I do it if it was a 20 million valuation? Would I do it if it was 15? You set the cap at the maximum valuation that you'd be willing to have it convert at. So it's meant to be an outer bound. If the company, so the reason this is tricky for people is that sometimes they think it's the current valuation of the company. So both founders and investors sometimes make mistakes like this and raise quite a bit of money on a low cap. This can be a problem for both sides. Even if you're an investor and you get a fantastic deal and you invest a small amount of money or a large amount of money on a very low cap, that can be a problem for the company down the line. Because investors are looking at each stage for the founders to be properly invested in the company. They want the founders to be motivated by the equity they have in the company. And if they don't have enough because too much has already been sold to early investors, it can really make problems for the company in raising money down the line. So even as an investor, it's not about getting the best possible deal you can in terms of getting the most equity. It's about getting a deal that will help the company grow now and in the future. So this note at the bottom is really just a quick back of the envelope question of if a company raises $1 million in convertible notes with a 5 million valuation cap, how much dilution did they take? And the answer would be they've sold likely at least 20% of their equity. And this is pretty straightforward when presented this way, but many times companies are raising a variety of notes at a variety of caps, and it's hard to keep the math straight of how much equity has actually been sold. And this, from the investor side, is really important as a value add for you as an investor to be able to help guide your companies through what the right way of setting their caps is and how many safes or notes they should be using to make sure the company is still fundable in the future. So let's go in a little bit into the math of each of these calculations so we can drive this home just a little bit more. So in this example, the discount, we'll have invested $200,000 here on the convertible, and we're setting a $5 million valuation cap or a 20% discount. Typically, the investor gets the benefit of whichever would come out to a lower price. So in this scenario, we've made this deal now. 6 months, a year, 2 years later, whatever it might be, the Series A term sheet comes in, the company has been moving along, and they get a $4 million pre-money valuation. So the way you figure out a price per share is you divide this pre-money valuation by the amount of shares the company has outstanding. So we come up with a number of $2 a share. Going through the math of a 20% discount, we show that these investors actually get to pay $1.60 a share. So when you divide that initial $200,000 investment by $1.60 a share, you end up with 125,000 shares as opposed to 100,000 if you were paying the full $2 a share. So pretty straightforward. The valuation cap takes things to a little bit extra calculations. So it's the same initial investment of $200,000 with a $5 million valuation cap or a 20% discount. But this time, the company has raised a Series A with an $8 million pre-money valuation. So if we do the same price per share calculation, the price per share now is actually $4 a share. So first we check the discount and we see that it's going to be $3.20 a share with the 20% discount. But in this case, we have a $5 million valuation cap. So highlighted in blue here, we show how you recalculate the price based on the valuation cap. So instead of using the $8 million pre-money valuation, you actually make it $5 million because of the valuation cap. So you come up with a new price per share just for these investors that have the $5 million valuation cap. So then the price per share becomes $2.50. So your $200,000 is now divided by 250 rather than 320 or $4 per share. So this results in almost a 40% discount for those initial safe investors. So you can see why a valuation cap is super important from the investor side to make sure that if a company is doing incredibly well and you only have a discount, then you might become very, very diluted very quickly. But the valuation cap makes it so that even if the company is a huge success, you don't unwittingly become slightly penalized for the company's success by being diluted by a extremely large amount because their next valuation came in really high. And this can be a little tricky for companies. If the valuation is too low or the valuation cap is too low, then it can be a tricky part of their negotiation when they're raising a Series A. So one key term to watch that we only just touch on here in the webinar, but is definitely a much bigger focus of the actual Deal Camp program, is understanding something like capitalization. This, as you saw in these previous formulas, was a big part of this formula of figuring out price per share. But capitalization can actually be defined differently in many of the different forms of notes, SAFE, or KISS that you might find online. And this is actually the key difference between the pre and post money SAFE. Basically, each of those forms use a different set of shares that count towards the capitalization. Now, I put on the middle of this slide the commonly understood definition of fully diluted capitalization. It basically means all of the company shares and rights to ownership. So if we're talking about a pie chart, it's the full pie. But in a SAFE, a note, or a KISS, capitalization is actually defined very specifically to include or not include certain categories of things. So it's almost never going to be the full pie. It will always count or not count some specific categories. And so I've listed them here at the bottom of things that you should be careful of to know what is or is not included in the capitalization for your note conversion. So one of those things might be an option pool, and any future increases to the option pool may or may not be counted in the capitalization. Other convertible notes may or may not be counted in your calculation. Shares issued to investors in the new round are almost definitely not going to be counted in the capitalization. And this option pool and other convertibles is actually the direct trade-off in the pre and post money SAFE. So one topic that continues to relate to capitalization is this idea of a cap table. Every company will have a cap table. If you're investing in a startup, it's likely one of the first things you're going to ask the company for when you're doing your diligence is you're going to ask them about their business model. You're going to get all of those things. But when you first start legal diligence, or even before that, you're going to ask, can you send me your cap table? And this basically just means a spreadsheet with the tracked ownership of who owns what shares or options or things that give them a right to ownership in the company. So this is important because it gives you a quick reference of who owns what, but also what people you might need to get together to make a majority vote to pass a certain resolution that the company needs to pass. One other variety of pro forma that people might have heard of before is called a pro forma. And the pro forma cap table is used when you raise a new financing round to model exactly how that will dilute the previous holders and what the ownership post financing will look like. So we'll look at a couple quick examples here. The most basic version of the cap table would just be common holders, AKA the founders. So in this case, we've got Elon and Mark who founded this company, probably a pretty good investment. And we show both the number of shares they hold and the percentage of the company that it represents. Here we also have an equity incentive plan, so an option pool for other employees. And so we've got about 10% in this option pool, and then the rest of the company is held by the founders and probably early employees. Now, if you're an investor and you ask a company for a cap table and you get this in return, you might be thinking, what's missing? And what's missing for most early stage companies here is probably a list of the convertible securities they've already sold. So if you've already sold convertible securities, they would not show up here on the cap table because it's just a convertible security for now. It hasn't actually translated into any ownership. So this could be a very accurate cap table and show all the current ownership, but it doesn't show you what rights to future ownership might have already been signed. So if you're investing in a company, you also want to know how much have you already raised, what were the terms of those raises, so you can kind of do some back envelope of the math to see how much equity has already been sold. Is this company investable for future investors? If you get this list and you see that the company has sold $1 million worth of notes with a $1.5 million valuation cap, you know that this company is going to have some trouble in the future because they've sold too much equity already. So here, just a quick example of a pro forma cap table. So this in the blue is the previous simple cap table we looked at. The green shows what would get added during a pro forma. So it starts to model out the new round. So for example, in this line, we have note holders showing how many shares they would convert into at this time. We have the new investors coming in and what percentages they might purchase. If you note here, we have the new investors purchasing 20% of the company. That's usually kind of the standard, what we would call market amount of dilution that you might want to model into each round. And then you see the new fully diluted percentages at the end of the round. So in this case, the founders, while starting around 70% of the company, after just the note conversions and this new round of financing, are now down to about 40%. So the dilution, especially when you have a set of convertible notes and a new round of financing coming onto the cap table at the same time, can be pretty jarring for a founder sometimes. And it really just depends on what the new valuation is, if that dilution is acceptable or if it's starting to be too much for the founders. I know we're moving pretty fast this morning, but this is just a taste of the kind of things that we would be covering during Deal Camp. So in particular, we would go much deeper into all of these legal terms, as well as building out these cap tables, where you'd have a chance to actually put one of these together in real time and see how these calculations work and be able to analyze one of these if you're doing some quick due diligence. The last thing I'll touch on is just a general outline of when you would use an equity financing. So remember, this is the second bucket we talked about in terms of convertible securities being for early stage companies and an equity financing happening once the company is just slightly more mature. And as I mentioned, this is a much more complicated transaction to get done. It will take a little bit more time, whereas you can reasonably get done with a convertible security within a week from start to finish. And equity financing is likely to take several weeks because you need to negotiate a fixed valuation and many, many additional terms. So this black box on your screen shows the usual documents that you might see for an equity financing in the US. And this is, 100+ pages of legal documentation, many of which are standard, but also some that do get negotiated. So it's really important to have a term sheet for an equity financing. And it's really hard to renegotiate those terms if they've already been agreed. So please, at the term sheet stage, if you're not very comfortable with all the terms being used, this is exactly where you would want to bring in your legal help, whether you're a company or an investor, to make sure that even though these things are non-binding, you want to make sure that the term sheet is correct, because it's very hard to renegotiate any of these points without giving something else back. The thing that's really important to know for people new to venture financings is that the first financing is usually the base of the ones that follow. So for example, if you raise a Series A, the Series B is likely to be the same set of documents with just some modifications to the investor names and amounts. So if you start with a set of terms that are not so good, it can be hard to get rid of them because people are likely going to follow the same set of forms they saw previously. Last thing to note for many of the people on the line is that the lead investor is primarily going to be the one negotiating these terms. So if you're joining a financing round and you're not the lead investor, the main and sometimes only way for you to get specific terms into your that you might require for your fund or for your own personal thesis is to use something called a side letter. And this is just a usually one-page agreement that gives you certain modifications to the main financing documents. And this is a really useful tool when you're perhaps coming in with a smaller check than the lead investor and you don't want to upset the process and create any changes to the main documents. So we're going to stop there and jump into the Q&A side of things. But as mentioned, I know this is super fast and a lot of dense legal terminology, but these are topics that we go into in much, much more detail during Deal Camp. And so I hope this was a good preview, but happy to answer some questions now that are more directly answering what you're looking for this morning.
Great. Thank you so much, Amit, for that incredibly insightful webinar. I trust everyone now knows a ton more about legal terminology for early stage investors. Again, we do go a lot more in depth in this for when we're doing the Deal Camp program, so check that out. However, if you are still craving info, now's the time to ask questions. So please, at the bottom of your screen, there's a Q&A function. If you do have questions, make sure to put them there. And with that, let's go ahead and dive right in. The first question, Amit, is in order to issue a convertible note or SAFE or a KISS, is there any difference or advantage between a corporation and an LLC?
So if you're the investor, you likely want to invest out of an LLC just because it's a pass-through for tax purposes. If you're investing from a corporation, you're likely not going to be it's not going to be the most tax advantageous way to do that. But obviously, taxes are very personal to your situation and to your setup. So there are times in which you might want to use a corporation, for example, if you're investing into a pass-through entity. But generally, most investors would want to invest in the most tax advantageous way, which would not be a corporation.
Great. Thanks for that. And then for the next question, so are SAFEs considered in fully diluted cap or not?
So I think that's the tricky part. That's one of the differences between the pre and post money SAFE. So in a post money SAFE, all of the other convertible notes, so a convertible note, a SAFE, a KISS, are all considered as part of the capitalization when you're making the calculations. In the previous version of the SAFE, those other convertible notes would not have counted. So it depends on which form you're using. And if you're asking generally, do SAFEs count to capitalization? If we're using the standard legal definition of all ownership of the company, they would not count. That might be a more confusing answer than you asked for, but I hope that sort of answers the question.
Great. So now we have, I think, 3 people asking this question. How do you calculate the valuation cap for an early stage company or the first round of funding?
Yeah, so the valuation cap is not going to be something that you calculate. It's going to be something that you agree on with the company. So if you're investing in the company, you and the company would have to decide on a valuation cap that you both agree to make the investment. There's no calculation involved there. It's just how you're setting it. As far as how you should set that, then that becomes a question of how do you think about valuation of early stage companies. And that we could spend hours on for a webinar. But valuation for an early stage company is extremely tricky. If there was a magic formula for that, it would make all of our lives easier. But unfortunately, valuation for an early stage company is down to a huge variety of things, including, competition for the round, comparisons to other companies that have raised. Depending on the industry, it could have something to do with the amount of revenue they're making, multiples compared to to public companies where they're trading, but valuation itself is very tricky.
Great. So what did you mean by the percentage of preferred in the pro forma?
That's a good question. Percentage of preferred in the pro forma is just showing which percent of the preferred is owned by which people. So we're just showing the note holders hold 26% of the preferred. The big time VC listed here owns 60% of the preferred, and 500 startups in this case owns 12% of the preferred. But the reason this is shown separately and broken out is that sometimes there are votes that are only require the preferred stock to vote. So it's a way to show you quickly whose votes you need to reach a certain percentage.
Great. Thanks for that. And then what would be the difference between pre-money safe and post-money safe?
So the main difference, as we were kind of touching on, was what counts towards the capitalization and the conversion. And the two things that are the main differences between the two are that the post-money safe counts all other convertible notes in the capitalization, whereas and does not count option pool increases, whereas the previous version of the safe is the exact opposite. So to put it in a more general sense, if you're an investor and you think the company is going to raise a lot more convertible notes, it's probably more advantageous for you to use a post-money safe. The company would feel the opposite. So the more convertible notes that are going to be raised and counted in the capitalization is more dilution that goes directly to the founders using a post-money safe.
Great. All right. So as an investor doing a convertible note in a startup, would you rather optimize for the cap or the discount?
I'd likely optimize for the cap because the discount is great to get a discount for taking the early risk and investing in a company. But if you invest with just a discount and no cap, you can run into that scenario I was describing, where say I invest $100,000 into a company, and then I just have a 20% discount and no valuation cap, and it turns out they've invented the cure to cancer, and then the next round is valued at 500 million, and all I get is a 20% discount. My $100,000 is going to turn into some very, very, very tiny fraction of ownership. Whereas the valuation cap kind of protects you from this potential of being penalized for the success of the company. So I would optimize for making sure the valuation cap is set somewhere reasonable to you. Unless, of course, like the only reason to use a safe with just a discount would be if you're reasonably certain that the next round is going to happen that you're reasonably certain it's going to happen and that it's going to happen within a certain time frame.
Thanks for that. Kind of a practical question here. What are the key differences between cap valuation kind of geographically? So in the Bay Area versus the East Coast versus other geos?
Yeah, I mean, I think that's probably, nobody can give you like a 100% answer there. I think that's just a question that goes to the difference between valuations in different markets to begin with. So we, at 500, we invest in markets all around the world. I think we're now up to like 75, 80 countries we've invested in. And I would say valuations get looked at differently depending on where you are. I think, traditionally the idea has been the valuations in Silicon Valley are a little higher. So, I would expect the average cap you're seeing to be a little higher here than I would on the East Coast. Same for most other markets other than China. But I couldn't say that there's one answer there. I would consider that to be the same as how you see valuations for private companies generally.
Fair enough. So here's a question focused in corporate venture. Do you see corporate venture capital approaches or how they approach convertible notes? Is it very different, or what is your experience with corporate?
Generally, it shouldn't be different. It should be the same because if it's a CVC or sorry, corporate venture or a traditional venture firm, ideally, it's still venture and it should operate the same way. A lot of times with corporate venture, there are other strategic goals rather than strictly a financial motive. So sometimes corporate venture has other requirements, like maybe executing a commercial deal at the same time or a side letter for some other types of things that might have to do with the strategic partnership. I would say that would be the main difference, but the actual convertible note itself should not be different.
Fair enough. So for a friends and family round prior to the formal funding, what do you see most frequently? Is it C notes, safes, or is it straight equity? Kind of what is your experience with that?
I would say it depends market to market, but in the US, it's most likely safes. I would encourage people to use a safe or a KISS rather than a convertible note itself for a friends and family round. Depending on where you are, convertible notes may or may not be as accessible or usable. Like for example, in India, you need special tax certificates to be able to do convertible notes if you're a company. In the UK, things look differently. In Latin America, there are other forms that are used. But basically, as long as you understand the concept of a convertible note is treated like debt, and if you have these other forms in your local market that aren't treated like debt, there's an advantage to using the one that still converts but isn't treated like debt. So you avoid these insolvency problems. So I would use whatever form I could that avoids that insolvency problem.
Great. We got one final question. So this is pretty specific. So as an investor, is a convertible note still an interesting instrument for 10 million in sales companies, or is it mostly used for early startups only?
I think you could use it whenever you'd like. There are plenty of companies that use it as a bridge round between, say, a Series A or a Series B when they have millions of dollars in sales and already have gotten millions of dollars in investment. So it's not strictly for early stage companies, but it's most common for early stage companies. And those bridge rounds might be a case where there isn't a valuation cap or there's just a discount and things like that. So I think it could be used. It could be used in a variety of scenarios, but the context really matters. So it's hard to give a blanket answer there.
Fair enough. And I believe that is it. We have run out of time, but yeah, there are some additional questions that came in, but I'll send those over to you, Amit, if you'd like to address those when we send out the recording of this session a little bit later. And again, I want to say thank you, Amit. If you'd like to learn more about VCU Deal Camp, you can check out the website https://education.500.co/Berkeley, or email me at vcunlocked@500startups.com. Again, it's going to be February 10th to 13th, and we expect spaces to fill up very quickly. So please apply today or as soon as humanly possible. And with that, any final words from you, Amit?
Nope. Just thanks everybody for taking the time and joining this morning. I know we went super fast through these things, but yeah, this is just a taste of the kind of stuff we cover at Deal Camp. There's much more time for questions and interaction, both with your peers and with the instructors at Deal Camp. And it's one of my favorite things to do during the year is to kind of share these concepts that are maybe a little bit dry and casual happy hour conversation, but with people that actually want to learn. So happy to talk more in the future and hope to see many of you there.
Great. And thanks again. Everyone have a good rest of your day, night, wherever you may be.
All right. Thanks, everyone.